Joining us now with a closer look at how all of this impacts the markets, Fidelity Investments Director of Global Macro, Jurrien Timmer, and Advisor Investments Chief Investment Officer, Jim Lowell. So, Jurrien, the characterization of the global hotspots sort of cooling off a little bit today and maybe some better data coming from the likes of China, as Carl mentioned. How much is this good for in the markets?
Yeah. Well, the markets are caught in a cross current, right? If you take a look at the markets from a glass half full perspective, you could argue, with all these negative headlines, trade, global slowdown, everything, the market's only a few percent below its highs. And all you need at that point is for something to go right, and the market could rocket to new highs. So that's kind of the optimist view. The glass half empty is that, the market's in denial, kind of like where it was in October of 2007, where the market kept going up despite all these negative trends going around us. My sense is it's somewhere in between. The Fed really needs to step up here and kind of feed the market, if you will, with what the market needs, which is more liquidity, lower rates. And obviously, it's likely to deliver on that in September. But, as you mentioned earlier, the PMI is below 50, and the yield curve is inverted. So the Fed needs to act here and step up. And I think as long as the Fed does that and we see any kind of moderate improvement in some of the fundamentals, I think the market stays in decent shape. But for now, third quarter earnings season is coming up in about a month, and we're probably going to see a few more downgrades before earnings season starts. So at this point, I don't think the market is going to be able to get out of its sort of late cycle purgatory, if you will.
It's kind of the debate on the Fed, Jim. What Jurrien just characterized. He said the market needs a rate cut. The yield curve is inverted. The market is craving more liquidity. That's the Bullard view versus the Rosengren view, which is the economy looks just fine. Why do we have to give the market everything at once? Jim, where do you fall?
I fall in the latter camp. I don't think the Fed needed to cut rates when they did. I don't think the fundamentals would drive them there yet. I think our Fed may be tipping a little bit more towards trying to be proactive rather than reactive. I think that's dangerous. They need to remain data dependent. Jurrien mentioned that this market reminds him of 2007, or this economy does. I think it's more reminiscent of 1999. The divergence between large and small cap performance, between growth and value stocks, between the international markets and U.S. is about as wide as I think it has been since then. And back then, don't forget, as we went into a fairly mild recession, what we saw was the large cap market sell off dramatically, and what is currently underloved and overlooked, small cap value names, actually came to the fore and delivered positive returns. So I think investors need to definitely make sure that their income needs are being met, their investment goals are well aligned, but their portfolios aren't chasing this relentless momentum into large cap growth stocks. There are better values to be had, and they will serve you better when this market does, in fact, take a downturn.
You mentioned income. Both utilities and real estate sectors in the S&P closed at record highs yesterday. Is that still the place to go, despite those kind of valuations, Jim?
In a well-diversified portfolio, they certainly can play a role, but you need to be very selective. We certainly think short-term bonds, cash. We know that some investors are reaching out to gold. We don't view gold as an investment, really more it's a tactical trading opportunity. But we think the best investment you can make in gold is to buy it and put it around the neck of someone you love. In terms of the overall marketplace, we think that this is a time where active management comes to the fore. We definitely think that just buying whole markets in terms of index funds is a risk mistake that we don't want our clients or any investor to make.
Jurrien, what is your strategy here for navigating through this choppy market?
Well, as Jim mentioned, a diversified portfolio remains paramount. And if you just take a very simple 60-40 portfolio, 60% S&P 500, 40% Barclays U.S. Ag, and over the past couple of years since the S&P made its initial valuation peak in January of 2018, that simple 60-40 portfolio delivered all the upside of the S&P, but only half the downside. And so to me, a 60-40 or some variation thereof remains a fairly bulletproof strategy because if things get better, the S&P or the stock side of the portfolio will deliver. and if they don't, the bond side will deliver. And so that's been a very winning strategy. And I do think that a combination of some of the bond proxies or stocks that have quality and dividends combined with maybe some of the secular growers will continue to be a good sort of barbell strategy. And, you know, as downtrodden as EM is, especially with all the trade tensions, EM, I think, it looks interesting here just from a contrarian point of view, and that if the Fed does ease more, which I do think is likely, that'll take some of the pressure off of the U.S. dollar, and that will allow the dollar to maybe weaken a bit, and that will bring EMs to life as well. So that would be my recommendation.